Can you see me?
Yeah.
Because you're not screen sharing right now, so I don't know. Yeah. This is me talking into the microphone. They don't have a sound thing. You know how some, it like shows you the sound waves?
Oh, we can hear you for like, great.
Here we are. Amazing. Let me grab my notes again. All right. Who knew technology would be so difficult? But hello and welcome. I am Barbara, founder of Your Tax Coach. If you don't already follow us on Instagram, I would highly recommend following on Instagram. And don't forget to like and subscribe our YouTube channel. I am going to be going live a lot more regularly just because I love like interacting with all of you guys. And so don't forget to always DM us if you have questions, give us some topics you want to learn about, but a little bit more about Your Tax Coach. We are a tax strategy firm. What the heck does that mean? It means we're not just bean counters. We're not just filing your tax returns with the numbers that you give us. We are there to dig into your numbers, dig into your finances, dig into your goals, and figure out ways for you to save money in taxes so that you can hit your goals faster. I had worked in public accounting for 10 years prior, and I was just fed up with accounting firms not helping their clients, not saving them money in taxes, never responding to emails or messages. And I was like, there has to be a better way. And so that's how Your Tax Coach started. And so most people come to us for our tax strategy service, where we dig in, find ways for you to save. We, of course, will prepare your tax returns. We have an entire tax team. I have almost 30 employees in a dozen or more states, and we help everyone in all the states, all 50 states in the United States. And so we are known for strategy, prep, we have a full bookkeeping team, and if you just need some consulting as well. We're also our world famous course called Write Off Your Life. It is such an amazing course. It's like self-paced, hundreds of little modules, like little bite-sized pieces that you can just pick and choose the deductions that you want to learn more about. And we are going to be launching our Write Off Your Real Estate course towards the end of March 19th, I think is when it kicks off. If you want to scan the QR code that is behind me, that's going to take you to sign up for our free masterclass for Write Off Your Real Estate. And in that masterclass, I'm going to go over 1031 exchanges and how to give your property when you pass away so that it's tax-free. We're going to go over opportunity zones. We're going to go over a ton of tax strategies for real estate. Today, I just want to touch on some of the tax strategies, but a lot of the foundational pieces that you will need in real estate in order to take advantage of all of the amazing tax benefits that real estate can have. I love real estate. I think it's one of the best ways to save money in taxes, but also one of the best and easiest and fastest ways to build wealth. Over 90% of the millionaires in the US own real estate and have built their wealth through real estate. I have to say before we dig in that this is not tax advice, legal advice, financial advice. So our attorneys make us say that as well. But don't forget to like and subscribe our YouTube channel so that way you can hear more of our lives. So first things first with real estate, you probably want to put your real estate in an LLC. Now, depending on how many properties you have and what states you're in, it might change a little bit. And again, we're accountants. This is not legal advice, but from a tax perspective, an LLC is great and it's going to protect you a little bit more. Now, in some states, there are series LLCs as well. And those can be great too, because then you can file less tax returns, which is awesome. And I won't go too deep into that now. I will go into series LLCs in our Right Off Your Real Estate course, but I want to dig in and make sure, one, you're putting your properties into an entity other than just yourself. So you're protecting yourself, you're protecting your assets. If you happen to get sued by a tenant, you're more protected. LLCs, that's just for investment properties. You probably want to hold your personal residence in a trust, but that's a different topic as well. Again, don't forget to put your questions in here so that way I can get them answered as well. Also with rental properties, please treat it like a business because really that's what it is. You're getting income for services and you have proper deductions with that as well. So make sure you're getting a separate bank account for your rental properties. Make sure the rents are actually going into that separate business account. The expenses that you might incur, those are coming out of the business bank account as well. Yes, you have to keep your receipts. Anything over $75 is what the IRS says, but I always say, like, I'm not keeping track of if it's under or over $75. Keep your receipts, scan them in electronically because we all know the ink disappears on actual receipts and your bank statements will not count. So please keep those receipts. Just get in a good habit of it. You can even have your kids scan in the receipts for you, and that's a great way to pay them through your rental property, and then you can get even more deductions. So let's go over some examples with real estate. I'm going to first give you an example, and I'm going to do a whiteboard example, and hopefully you guys can read my handwriting. But let's go over an example for a business owner. Oh, hey, Crystal. Can they see the whiteboard? Because on here, I just see myself. Oh, okay.
Yeah.
Perfect. Okay, so I'm going to first go over an example for a business owner, since that's usually who we help, business owners or real estate investors. So let's say you profit $300,000. Well, that's your revenue, let's say. You're going to have deductions, let's say of 100K. So your profit now is 200,000. And these could be cool deductions. Like some of the reasons I love real estate, those deductions, you can take a home office. You're going to probably take mileage or get a cool vehicle for your rental. You're going to have meals deductions because you have to meet with, maybe you meet with a contractor, a vendor, whoever, maybe you pay your kids. Oh, whatever you did there made it stop. There we go. Maybe you pay your kids. So there's the 100K deductions. It could be more than that, but your profit's now at 200,000 and you work with us. So we tell you, why don't we put $51,000 into a self-directed retirement account. Why? Well, one, I want your income less than 150K. Because you can take more real estate deductions, but also when you put the money into a self-directed retirement account, you can take that money out, you can pull that money out and use that as a down payment on a rental property. So now let's say your taxable profit is 149,000. Now, if you have a business and your profit is 149,000, let me just show you how much you're going to pay in taxes if you didn't invest in real estate. So on 149K, you're going to pay $22,549 in federal taxes. You're going to pay $18,228 in Social Security taxes. You're going to pay $4,321 in Medicare. And you're going to pay if you're in, let's say you're in Arizona, I just picked a state with like kind of a median state tax rate. It's actually kind of a lower tax rate, 2.5%. But you're going to pay in Arizona $3,379 to the state. This right here, Social Security Medicare, it's also known as self-employment tax. But just those taxes alone, you would be paying $48,477 in taxes. So your $149,000 profit, really the cash in your pocket is only $100K because you had to pay so much in taxes. So let's say I'm like, well, instead of paying this $48K in taxes, $49K, we'll say, 48K works. Instead of paying $48K in taxes, let's put $48K down on a rental property. So typically rental properties, you have to put 25% down. So that would give you like a property that cost $192,000. If we cost segged that property, which I'll go into that in a second, let's say it gave you $50,000 of depreciation deductions. And I'll get to that in a second for if you're like, what is that? But then also, remember, you put 51K into a self-directed retirement account up here. So not only are you going to take that 48,000 and buy a rental property number one, you're going to buy rental property number two with that 51K. Let's just say you use 50K. So a $50,000 down payment is going to let you purchase a rental property for $200,000. And we're going to cost seg it, so it's going to give you another $50,000 depreciation deduction. Okay, so let me go over depreciation really quick. Depreciation is what you get to take on real estate. And in a single family home, you get to take depreciation over 27.5 years. So you would take the purchase price of the property, let's say 200,000 divided by 27.5, and that's what you get to take every year as a deduction on your return. So let's say, just for easy math, maybe you bring in $20,000 a year in rental income and your depreciation deduction is like $8,000. So you're not taxed on the $20,000 that you're bringing in. You get to automatically take $8,000 off of that. So you're only taxed on $12,000. Pretty cool. Like you're taxed at a discount because of a rental property. But even better, if we can do a cost segregation study, which is just a fancy word that allows us accountants to accelerate your depreciation. So instead of taking only $8,000 that year in depreciation, we get to take maybe $50,000. That's an estimated number. It's anywhere between like 20% and 35% of the purchase price of the property. So I just kind of averaged it and I said, well, maybe we can take a $50,000 deduction in year one or whenever we do the cost seg study. So to go back to the whiteboard, one second. Do you know how to go back to the one I was on? Let me go back there. That way we can see all of our numbers. Sweet. Okay, so back to these numbers. So you're able to purchase one rental property for 192. You purchase a second rental property for 200,000. Now, not only are you a business owner bringing in 300,000, but you're only right now taxed on 100 $149,000, but you also have two more assets available to you, two rental properties that are bringing you in cash flow every single year. How amazing is that? So now let's go over all of the benefits of owning this real estate besides just the depreciation. I'll circle back to that when we're done there. Actually, let me show you just the depreciation part right now. So if you remember from up here, right now our profit is 149,000. And that's where we had to owe like $50,000 in taxes. But we bought these two properties. So now we get both of these $50,000 deductions. So you get to deduct another 100K. So now taxable income is only 49,000. So now your federal taxes due is only $3,998. Your Social Security and Medicare taxes are only $3,749. And your state is only $879. That's if I just used Arizona as an example. So you're at like 4, 8, maybe 9K in taxes, whereas up here you were at 49,000. So would you rather pay 49,000 in taxes, or would you rather pay 9,000 in taxes and have two more assets? Right? Anyone would choose only paying $9,000 in taxes. So let's go over more benefits of rental properties. I'm just going to use one of the rentals at 200,000 because the math is easier there. So let's look at all the benefits. And I'll tell you, when we're purchasing rental property, we want to purchase rentals using the 1% rule. So what is the 1% rule? Well, this rental that we bought was $200,000. So you take 1% of that. You want to get rents of $2,000 a month. And that's like a quick and dirty way to see if sorry, I'm seeing on the screen, they can't see my whole screen. Do you know how to switch that? Yeah, perfect. You can probably zoom in a little more. Yeah, great. Okay, sorry about that, guys. It's our first one, so we're going to work out the kinks, I promise. Okay. So that's kind of our quick and dirty rule of, are we going to make money on this property? So let's say that this property you can, even if you get close to the 1% rule, maybe like 0.75 or 0.8 even, but just for easy math, let's say $2,000. I also looked up what a mortgage would be, again, with property tax and insurance as well. So your mortgage is around $1,300 a month. So you can already see like you'll cash flow, right? You're going to bring in $2,000 a month. Your mortgage and everything's only $1,300. So let's calculate some more benefits besides depreciation, but we'll go over depreciation again. So benefit numero uno, cash flow. And for easy math, let's just say you're cash flowing 500. I know this is showing 700, but maybe there's other expenses or whatever. So you're cash flowing 500 a month. What does that equal per year? 6,000, right? And what did you have to put down on that rental property? Do you remember? You usually have to put down 25%. So 25% of 200K is 50,000. So you're going to calculate what's your cash on cash return. You're going to take the 6,000 divided by 50,000, which equals 12%. So you're making 12% annually just from cash flow. great, right? Like the S&P 500 averages 11% over the last like 60 years. Retirement accounts, like financial advisors, they want you to make like 6-7% a year. You're already at 12%. Amazing. But that's not the only benefit. Another benefit is equity. What does that mean? That's how much is your property going up every year. And let's say on average, properties go up 5%, which is true. Sometimes it's more, but usually your property is not going to go up any less than 5% a year. So you're going to take, oh, sorry, this was not equity. I'm going to erase this. Appreciation. It's going to go up 5% a year. What's 5% of 200,000, your purchase price? That's $10,000. So it's going to go up $10,000 per year. What's the cash on cash return of that? You're going to take 10,000 divided by what was your cash out of pocket, 50,000, right? For the down payment. So 10,000 divided by 50,000 is 20% cash on cash return. So now you have 12% and 20%. You're already at a 32% cash on cash return. Benefit number 3, like I was mentioning, equity. You're going to get equity from the appreciation, but you're getting equity because someone else is paying down your mortgage, right? Those people renting from you the $2,000 a month, you're using that for the $1,300 a month mortgage that you have. And so you're building equity. Now, for this example, if you guys know amortization tables and mortgages, you know that when you first make payments, you're only going to be paying like dollars against your principal and the rest is going to interest. So on average, people keep rental properties for 5 years. So I took what equity would you have in 5 years and I divided it by 5. Just so if any of you like math nerds out there are going to comment and say, my math is wrong, that's how I got the numbers. So on average, you will have gotten $12,000 of principal pay down in the first 5 years. So I took 12,000 divided by 5, which was 2,400 a year. Now you're going to take 2,400 divided by your cash out of pocket, right? And there's another 5% that you're making every year. So 12%, 20%, 5%, you're now at 37% cash on cash return. Number 4. So we went through cash flow, equity, appreciation. Now let's go into the tax bennies. My favorite, right? So in a regular world, you would be getting $7,272 in depreciation every year. Now, how did I get that? You take 200K divided by 27.5, because we're assuming this is a single family home. But the other tax benefits, right? You're going to be writing off home office deduction in your real estate. You can write off mileage. You can write off meals, insurance, HOAs if you have it, all the utilities. Let's say there's like pest control. You're going to have repairs. Let's see, what are more fun deductions that you get to take? Maybe some travel expenses because you buy the property in a really cool place. So you want to travel there. You now get to travel there and write it off because you're going to do repairs on the property. And so let's say you're at a tax loss every year. Tax loss. That doesn't mean you're actually losing money, but you're losing money on paper. That is the best thing ever for taxes. So let's lose money on paper. Let's say you are losing $12,000 every year on paper. So you're going to take $12,000 times your tax rate. Let's just assume you have a 30% tax rate. So you're saving another $3,600 a year out of pocket. You're going to divide that by your cash. Remember, your cash out of pocket was $50,000. And so there's another 7% cash on cash return. So to recap, we had, well, I don't know what just happened. There we go. We had 12%, we had 5%, we had 7%, we had a 20%. So you're now at 44% return year over year. And you saved a ton of money in taxes. So that's just those 4 things without doing the cost seg. But remember, we're going to do the cost seg. And what did I say? Instead of the $7,000 of depreciation, it's estimated we're going to get $50,000 of depreciation. So you take 50,000 divided by 50,000, your cash out of pocket, and there's already 100% return on your money. You take that as well as your 12%. Instead of the 7% for depreciation, it's now 100. So you're going to take 5% and you're going to take 20%. So now you're at 120, 132, 137% return year 1. And then the rest of the years, you're probably going to get likely around like 40%. Like these examples. That's just from one property. So you can do the same example if you want to test out the math. You can do this same example with the second property that I did the example for up there. Has there been any questions? Okay, perfect. So if you're watching this later and you have questions, feel free to put them in here and we can answer them in the next live, and or you can DM me on Instagram and I'm happy to answer there as well. Let's see, I just want to check my notes and make sure I went over everything I wanted to go over today. So we went over depreciation. We went over it's 27.5 years. If you're buying a residential property, it's 39 years. If you are purchasing a multifamily commercial property, also 39-year is Airbnb property as well, if you didn't know that. So if you have any short-term rentals, Airbnb properties, those are 39 years. So let's go over the short-term rental loophole, and that should get us to our time. Sweet. And I see Miriam's question, just learned about cost seg. Our rental 15 years is still worth doing. I'm not sure your question. Are you saying that you've had your rental for 15 years? And if so, it might be beneficial. We'd have to talk about numbers if you've put any money into the property since you've purchased it. Okay, that was Miriam's question on Instagram as well. And then how to deduct time if you manage your investment property. You do not get to deduct your time unless you create a management property company and your rental is paying the management property company, but then your management property company has to claim that as income. So unless you have other expenses to offset that, it might not make any sense. But the good news is you wouldn't have another, property management company that you'd have to pay 10% to or something. Okay, Jennifer is asking, are odometer readings required on mileage logs for personal vehicle usage? Well, not necessarily, but you do have to keep a log somewhere. So a big suggestion is to take a picture of your odometer. Is that what it's called? Odometer? The mileage thing? Sure. Take a picture of that mileage thing at the beginning of the year and take a picture of it, like if you remember at Christmas or something like that. Just put it in your calendar to take pictures of it so you can prove the beginning and ending mileage. but also you should have a mileage tracker. So you can either use something like Mile IQ is a great app. You can use, if you use QuickBooks Online, there's a mileage tracker in the app of QuickBooks Online. So you would have to download the app to your phone. Or you can keep a log. Like some people legit still write logs. Like I wouldn't do that, but some people do. So if you want to track it the old fashioned way, like handwrite it or in a spreadsheet, but yes, you have to keep track of your mileage. So let me talk about the short-term rental loophole as well. So for some people, you can't take your rental losses against your other income. And that's if your income's over 150K, which is why in that example, I used an income of less than 150K. But also, if you're not a real estate professional, then you can't take your real estate losses if your income is above that. So how can we take our real estate losses so that we can save money in taxes if there's no other way? And in the real estate, the masterclass that I'm hosting, don't forget to scan that QR code. In the real estate tax strategies masterclass, I'm going to go over rep status and how to qualify for all of that, but that's too much just for this one live. So if we can't take your losses against your other income, a really cool strategy is called the Airbnb loophole or the short-term rental loophole. Because if your property on average, the stays are less than 7 nights per stay, you can claim that kind of like active income, which would really be active losses, and it'll offset your business income. It'll offset your W-2 income. So for our clients that are like really high income W-2 earners, we have them purchase Airbnb short-term rentals because we can typically offset that from their W-2 income. So remember, it's an if your short-term rental stays on average are less than 7 nights, and you still have to materially participate. Now, material participation, there's 7 different ways to hit that, but the most common way is the 100-hour rule, which means you need to spend 100 hours a year on the property and more than anyone else. So hitting the 100 hours, if you manage the property, is pretty easy, right? You're going in there, you're cleaning, you're doing repairs. Even if you're not doing the cleaning, that's fine. You can probably spend 100 hours just like texting back and forth with all the people staying there, the check-ins, the checkouts, the Wi-Fi is not working and, blah, blah, blah. All the million reasons people reach out to you on Airbnb. You can probably hit the 100 hours, but it also has to mean more than anyone else. You have to make sure your cleaners are not spending 100 hours in there. You have to make sure any people doing repairs are not spending more than 100 hours, things like that. Now, a way to get around the cleaners, because they do spend a lot of hours, is like swap out the people. It's only a person, not a company. So usually it's like a cleaning company that you hire, and every time it's a new person, or every 4 times it's the same person, something like that. So they're probably not spending 100 hours per person anyways. So that's okay, that works. So you want to buy an Airbnb short-term rental and still spend more than 100 hours on it. And then you can take the big losses on your short-term rental. We can cost seg the property, accelerate the depreciation, take even more losses against your W-2 or business income. That's the short-term rental loophole. I'm not a huge fan of short-term rentals because I think it's a lot of work. But for our people that can't qualify another way, it's great. Another trick, if you are someone that's like Airbnb is a pain in the butt, is you can buy a property as a short-term rental in 1 year, take the big losses, take the cost seg, and offset those losses against your W-2 income. And then the next year, you're like, actually, I don't want to Airbnb it. I realized it's too much work. I'm going to long-term rent it. And that's okay, because you already took the big losses in the first year. But then the next year you switch it to a long-term, and that year you do the same thing. Maybe you find a property that would do great on Airbnb. So you buy another one, you Airbnb it, you cost seg it, you take the huge depreciation deductions, and then you switch the intent of it another year, or you decide Airbnb is too much hassle, or maybe the Airbnb market slows down in that area, so you have to switch it. There's a lot of reasons why people switch back and forth from short-term and long-term rentals. So I hope you guys loved this YouTube live. Don't forget to like and subscribe so that way you see all of our videos when we're uploading more and more stuff. Our real estate tax strategies masterclass is coming up on March 19th. So don't forget to sign up for that. That's going to be amazing. We'll have like 2,000 people in that class, which is going to be so fun. You can ask all of your real estate questions there. Our Write Off Your Real Estate course is launching March 19th. You have 10 days to buy it and still get live Q&As with me, which will be so fun. And you'll get discounts on it as well. And don't forget to follow us on Instagram because I love hanging out with everyone there. So thank you for watching live, and I will see you all soon.